Today is part of our ongoing Center for Ag Profitability's weekly webinar series, usually happening every Thursday afternoon at noon Central Time. Of course, please look for a full schedule on our website at cap.unl.edu. You'll find a schedule of our upcoming webinars as well as recordings and archives of our previous webinars. With the new year, agricultural producers and professionals face new farm program decisions, new production decisions, new participation decisions as well. So they face new farm program decisions and directions under the agricultural risk coverage and price loss coverage programs available through USDA's Farm Service Agency. This webinar will provide an update on those farm programs and other relevant programs, such as the Non-insured Crop Disaster Assistance Program and the Dairy Margin Coverage Program as well, along with other assistance for producers. We're pleased to again collaborate with Nebraska's Farm Service Agency today. We welcome our other presenters to the program today. Cathy Anderson has joined us in previous years. Cathy is a Production and Compliance Programs Chief at USDA's Nebraska Farm Service Agency State Office. Today, she'll discuss farm program decisions for 2022 and review the current pandemic program assistance that FSA is rolling out to producers. Cathy, thanks for joining us today. We look forward to your discussion. Jessi Remmers is also joining us from Nebraska's Farm Service Agency State Office. Jessi's a program specialist, and she's here to discuss the Non-insured Crop Disaster Assistance Program and to touch on the dairy margin coverage. The Non-insured Crop Disaster Assistance Program, or NAP, is an important component of risk management tools that are provided through FSA to complement where crop insurance does not particularly fit. And so Jessi will talk about NAP and talk about the Dairy Margin Coverage Program as well. Thank you for joining us today, Jessi. She'll join us in that session as well. So that's it to start. We also thank Bobby Chris-Wickham from Nebraska's Farm Service Agency. Bobby's with us today as well and helped to organize and confirm our arrangements for today's program. So we greatly appreciate the collaboration between FSA and between Nebraska Extension, and we want to share some information with you today on farm programs and the farm policy outlook. I want to start with a brief discussion of farm program outlook today to sort of set the stage economically for where farm program decisions fit in 2022. Cathy and Jessi will talk about FSA details and other program assistance then, and we'll come back to a broader outlook of farm programs and farm policy ahead. If we look specifically at farm programs, we're going to focus on that current farm income safety net. We'll look ahead at the end to the farm income outlook and the 2023 Farm Bill outlook ahead. Don't forget there are lots of other policy issues on the horizon. We'll not touch those today, but remember that producers are operating in this very complicated risk management environment. There are issues to face with production, marketing, financial, legal, and human risks, and there are a broad range of risks that producers face under each of those areas. We're talking specifically about farm programs that fit under the legal component, but they also obviously have very important considerations for us in terms of managing production risk, market risk, and financial risk as well. So recognize that it's a broad risk perspective. We have an important role to play in risk management education, both here at Nebraska Extension and through our North Central Extension Risk Management Education Center. That gets focused today on our discussion on farm programs. When we talk specifically about farm programs and the decision that producers have here in 2022, remember again, it is ARC versus PLC, and it's the same ARC and PLC that we've effectively had since 2014. It was updated in the 2018 Farm Bill, and producers faced a new decision. But in 2019, the first decision that they faced was really somewhat of a backward-looking decision because ultimately it wasn't complete until early 2020. And producers made one decision about the 2019 and 2020 crops together. But it was backward-looking in the sense that results from 2019 were already largely known, at least production-wise, and we had some idea about markets. And we also had an interesting, or at least an initial look, I should say, about expectations for 2020. And producers responded accordingly. That included a lot of participation, a substantially larger amount of participation in something called ARC individual coverage, because producers knew exactly what they already faced on their farm at that time. But beginning in 2021, The decision is forward-looking, and producers have the opportunity to change their enrollment each year. But when they change their enrollment or when they look at that decision, it's always forward-looking now. And 2021 was the first year, 2022 is now the second year of this. It's difficult to predict losses looking forward. It's really difficult to predict yields at anything other than benchmarks, which are the benchmark yields incorporated into the ARC guarantee. Wheat is the one exception. Wheat's already in the ground, and we have some idea what we think production may or may not look like for the year. Oftentimes to be proven wrong with wheat. That's an aside. But at least for most crops, we have to make a decision looking ahead to the production year. Price projections are already available if you consider futures market ideas, or if you consider some long-range budget projections, but we generally don't know them either at the time we have to make this decision. So we're making it more on long-run expectations. When we make the decision, we also should not forget the decision we make about farm programs does have an impact on our crop insurance and marketing and broader risk management decisions. Revenue protection or revenue protection without the harvest price exclusion, or yield protection. Don't forget that those policies are also available, and in a higher market have a much more important role to cover risk than what underlying farm programs might. We also have some of the enhanced and expanded coverage, the SCO or supplemental coverage option, and the enhanced coverage option or ACO, that may help to cover part of that deductible portion that crop insurance doesn't cover. But the tie-in here is not just the crop insurance and farm programs, both provide protection. It's that the SCO policy specifically is limited based on whether you do or do not enroll in the ARC program. And so there is a linkage here between making a decision in farm programs and then making a decision about crop insurance. They both face a deadline coming up here, and they're both worth thinking about now as we go forward. So some detail on farm programs specifically. And first, a very brief reminder of where we've been. The 2020 crop program is long gone at this point. Payments were made in late 2021, in October of 2021. But remember where we ended up and how this fundamentally works. Ultimately, the market price ended up there in the third column. Corn ended up at $4.53. That's well above the $3.70 reference price, which meant that there was no PLC payment. It was 22% above where the ARC benchmark was at $3.70, which meant it would have taken a very large yield loss in order to trigger ARC payments. And that same scenario played out for other major crops, grain, sorghum, and soybeans. Wheat was the exception, where the wheat price at $5.05 remained below the $5.50 reference price. That resulted in a 45-cent payment rate, and it resulted in potential ARC payments at a much smaller yield loss as compared to the other programs. I set that up in that chart to explain this chart. In the 2020 program, we see the number of county and practice combinations, that is, counties where it is all crops combined, plus counties where there is an irrigated practice and a non-irrigated practice. That's the total number of combinations out there. We see what the average payment was across across all counties and practices. And we see the yield loss that it was needed to trigger any potential payments. Ultimately, there was a very small number of situations where there was actually an ARC payment triggered. Remember, there was no PLC payment for corn or grain, sorghum, or soybeans. There were a very small number of county practice combinations that we actually triggered an ARC payment. And it took a large yield loss to do so. In wheat, there was a PLC payment as a reminder that prices were not as high. That, not surprisingly, meant that more counties also triggered an ARC payment. And you see the results. All of that for 2020 to remind you where we look for payments going forward here. For the 2021 crop year, again, we're talking about a 2022 decision, but looking back for the 2021 crop year, with payments that are due in October of 2022. If you take current projected prices as per the USDA World Ag Outlook Board's monthly agricultural outlook. If you take those projected prices, they are far above the effective reference price that would kick in any sort of PLC payment. There may be one commodity in the entire portfolio, I think, that kicks in a potential PLC payment right now, and that's not one we grow in Nebraska. It would take a substantial price loss to trigger any sort of PLC payment, which is first to say that there's not any real projected cash flow from the commodity program coming this fall. It's also a reminder that there's a lot of price risk before the farm program would kick in here to help. With prices that far above where PLC would kick in, they're also substantially above where the ARC benchmark starts. They're 47% above the ARC benchmark for corn. They're 38% above the benchmark for grain sorghum, etc. That means we have a requirement. It would take more than a 30 to 40% yield loss at the county level to trigger any ARC CO payments for the 2021 crop to be paid in October 2022. It's possible that it happens. It's possible that some combination of prices and yield expectations could fall from here, and that combined there is actually situations where it would trigger. But the expectations are very small and the probability is very small. So it's a reminder that there's not much protection to be had, not much cash flow on that 2021 crop to be paid later this year. It really is more protection from other tools and other decisions. That's 2021. If we think about how that looks going forward, we can try and draw this line out here on the chart, and you recognize that prices have moved substantially higher. They are above where PLC would kick in. They are above where ARC would fundamentally kick in. And I've drawn a line there in blue that is the ARC benchmark price. The dashed line in blue is 86% of that. If you remember that the ARC guarantee is benchmark price times benchmark yield times 86%. Well, this is 86% of price. That's effectively where the protection starts if you hit benchmark yields. Now, it's a revenue protection, not a price protection, and so it's the combination of, but it's also a reminder that we're substantially above levels where either ARC or PLC would kick in. That's the case for corn. That's the case for soybeans. The ARC protection is a little bit higher relative to PLC for soybeans than it is for corn. The probability of support under ARC versus PLC is a little bit more favorable in soybeans than it is for corn, but the expectation is really small regardless. The table for 2022 looks like this. We have the same effective reference price. There's a possibility that reference prices could grow with higher market prices, but that possibility doesn't really exist for the life of this farm bill. It would take a continuation of policy before that fundamentally could happen. The ARC benchmark price is plugged in there as well. That's a 5-year Olympic average, lagged a couple years. So you see where the benchmarks or where the effective reference price starts for 2022. The projected price is based on some USDA projections in late 2021. It is not a market a market projection or current market outlook. It's just really a baseline to start with. And it's relatively modest compared to what markets are currently signaling in the 5-something corn and the 11 or 12 or 13-something soybeans. So it's a number. It's not meant to be a market projection. Please note that here. But at that number, we're far out of the money in terms of what a PLC payment would do. It would take somewhere between a 15 and 20-something% loss for a PLC payment. Similarly, if those prices are that far above the benchmark, it would take a 20 to 30-something% yield loss in order to trigger an ARC payment in 2022. It's possible, but the likelihood of it happening is relatively small. If I do some analysis on the online decision tools from Texas A&M University or from the University of Illinois, those analyses will tell us there's an average payment because approximately 2 or 3% of the time out of 500 draws, it actually happens. Or the analysis will say that maybe between 10 and 25% of the time, it actually triggers a payment. It's small, and the expectation is nothing, but the potential is it does at least exist in a very few cases. Now, that's a setup to where we think we're going with the 2022 crop program and the economics of that. But for those producers that need to make decisions, it's important to remember the details, and it's important to remember the other information from FSA. And so I want to stop sharing my portion there for the moment and look to Cathy to join us this afternoon and to share the FSA material as well.
Thank you, Brad. I appreciate the introduction, and I'll say good afternoon to everyone. I'm very glad you've all been able to join us. And we especially appreciate the opportunity to do this every year. So our thanks go to the University of Nebraska for that collaboration as well. I will attempt to share my screen and my presentation. There we go.
Cathy, it looks good.
Okay, great. So today, my colleague Jessi Remmers and I will, sorry, I'm having a little trouble here advancing. Let me see if I can get that to go. There we go. My colleague Jessi Remmers and I are going to visit with you basically about 4 different areas. And again, that's the agricultural risk coverage program and the price loss coverage program. You'll hear me refer to those as ARC and PLC. And we want to ensure that you're aware of our March 15th, 2022 deadline for both making a new program election, if you so wish to do that, and also to enroll in your annual contract. And then Jessi's going to discuss the Non-Insured Crop Disaster Assistance Program, or NAP. And that does have a March 15th deadline for some of the specific crops that can be covered under that program. Also, again, she'll visit about the Dairy Margin Coverage Program with a February 18th, 22 deadline. And then we just want to touch quickly on some of the pandemic-related assistance programs. So I will start by talking about ARC and PLC. I'm going to go over this presentation somewhat, giving more of a brief overview than maybe I have in the past couple of years. We've got more information available here in the presentation, and that's going to be made available to you. As Brad noted, the program really hasn't changed since the 2018 Farm Bill, and really there were just a couple of minor changes since the 2014 Farm Bill when it was also effective. So I will move through some of these slides a little more quickly, but I do want to say at the end of the presentation, we do have our number. If you want to reach me here in the Nebraska FSA State Office, I'll be happy to talk to you about any questions that you might have. So ARC and PLC are our primary commodity crop safety net programs that were implemented as part of the 2018 Farm Bill. And again, we note our upcoming deadline. So before we talk about the specifics of each one of those programs, again, we just want to talk a little bit about the election. And both ARC County or PLC can be elected on a crop by crop basis. So you may have base acres on your FSA farm for corn and soybeans and wheat, and you could elect into PLC on your wheat base acres, ARC County on your corn and soybean base acres. So those are individual crop-based decisions. However, if you do decide that you would like to elect into ARC individual, then that election is going to apply to all the covered commodities on the farm. So that would be all the crops with base acres. Now that program election is made on the same form as your annual contract enrollment. So it's a pretty simple and straightforward process. If you happen to have signed what we call a multi-year contract back in 2019, if you chose that option in 2019, you are essentially saying that whatever producers and shares were designated on that 2019 contract would continue to roll forward for 2020 and subsequent years. And you really don't need to take any action to change that unless there's been some change to the producers and shares on your farm, or unless you want to make a different program election. So you may want to just double check with your county office if you think you have a multi-year contract in place to make sure that that enrollment is there and that you don't need to come in and do an annual contract. If you do choose to make a new program election, just note that that has to be a unanimous decision by all 2022 producers on the farm. And when we say producer for this purpose, what we're talking about is anyone that shares in a crop that's on cropland designated as such by FSA. So FSA cropland on a farm can sometimes include some acres that were previously in row crop production, but maybe now are in a non-covered commodity such as alfalfa or grass. So you might want to just check with your county office to be sure, if you're making a new election, what all acres are considered to be part of the FSA cropland, so you know who all needs to sign that contract. This slide is just a reminder of what we consider to be the 22 covered commodities. And you'll hear me use that term when I talk about base acres on a farm, but you'll also hear me use that term when I talk about the ARC-IC program, because the ARC-IC program does require that you have at least 1/100th of an acre of one of these covered commodities planted in order to be enrolled. So let's start out by talking about price loss coverage. And the fundamental difference you'll note between PLC and the ARC programs is the type of risk management protection that's provided. PLC is strictly a price protection program. So there's really no protection against yield loss in a specific year. The ARC programs, which have two options, you can either elect that at the county level or at the individual farm level. Those programs are providing protection for revenue losses. So revenue losses could be declines in either price or yield. And Brad talked about that when he showed some of the projections for the upcoming year and the likelihood of those losses occurring. So with PLC, payments are simply triggered when the effective price, so for 2022, we'd be saying what the average price received for a crop was. When that price dips below the effective reference price, then a PLC payment will be triggered. Now, for all three of these options, we always are going to issue payments after October 1st of the following year. And the reason is because we have to go through an entire marketing year for that crop in order to determine what the average marketing price was. So this slide references or shows you for PLC purposes what the reference prices are as established for each crop. And those prices are established as part of the Farm Bill, and they remain the same throughout the Farm Bill through 2023. So this just talks a little bit more again about the PLC effective price, and that's our determination of what the actual price was for that 2022 crop. And again, we're going to compare that to that effective reference price to determine if there's a price loss that triggers PLC payments. So how will we determine whether or not there's a payment rate on a specific crop that you have base acres for? Again, we're simply going to look at that effective reference price, which was statutory and set by the Farm Bill, for instance, $3.70 on corn, minus the effective price, whatever that marketing year average price for corn is. And the result of that, if the effective price is less than the reference price, is our PLC payment rate. And I think Brad also had a slide on this, but for 2020, the determinations for those payments were just issued in the fall of 2021 after we went through the 2020 marketing year. We could see that corn, soybeans, and grain sorghum did not earn a PLC payment because their market year average price was higher than the reference price. But wheat did. The wheat reference price of $5.50 was higher than the market year average price of $5.05. If there is a payment rate on a crop elected into PLC, how do we then convert that into a PLC payment for the farm? Well, we'll take that payment rate times the crop base PLC yield. So that does say farm PLC yield, probably should say crop PLC yield because each crop that has base acres has a separate PLC yield. And then we'll take that times our payment acres. And for purposes of Ark County, payment acres are the base acres you have for that crop on the farm times 85%. And the result of that is our PLC payment on the farm. Now, I do want you to note that PLC payments are not dependent on the planting of the crop. So you could have base acres for corn and soybeans and wheat on your farm, and you could have the entire farm planted to a crop that's not covered, such as alfalfa. And that does not impact your ability to earn a PLC payment. So we do have a slide with an example using some numbers here to just better illustrate how that calculation works. So moving on to ARC, we want to talk about the two different options under ARC that are available, and that's ARC at the county level, or ARC-CO, and ARC at the individual level, or ARC-IC. And first, we'll start with ARC County. So ARC County is an income support program that's based on a benchmark, or I like to call it an expected county level crop revenue. And then we take that expected revenue and we guarantee that at 86%. To come up with that benchmark or expected revenue, we're going to use county level yields and national average prices. And we'll do the same when we try to determine an actual revenue for that crop in 2022. And then there's just simply a comparison of that actual revenue for the crop using county level yields and national average price to the guaranteed level revenue. So under ARC County, these four bullets I just want to make note of because these do outline some of the key differences between ARC County and ARC Individual or ARC-IC. So under ARC County, revenue losses are determined for a crop independent of other crops on the farm. You could have base acres for corn, base acres for soybeans. Both are elected into ARC County, and we'll determine the loss on corn separate from the loss for soybeans. The covered crop does not have to be planted on the farm. So similar to PLC, the entire farm could be planted to alfalfa, but you could have corn and soybean base acres on your farm and elect those into ARC County, and they would still be eligible for a potential payment. If a revenue loss does occur, payments are issued on 85% of the farm's base acres. And again, we term those as payment acres. So that's similar to PLC. And with ARC County, there is no requirement that you have to report your actual production. And that's because we're relying on those county average yields and not your individual farm yields to determine the revenue. This is a slide that talks in more detail about the benchmark revenue and how that's determined. And this slide goes into a little more detail about the actual revenue and how that's determined. So again, payments are triggered under ARC County when the actual county revenue for a crop is less than that guarantee, which is 86% of that benchmark or expected revenue. The next few slides, again, provide a specific example so that you can see how actual numbers plug into those formulas. I do want to mention a couple of things in regard to ARC County. The first is in regard to certain crops and counties that will have revenues calculated separately for irrigated and non-irrigated yields. And we do summarize those revenues using a weighted formula to determine one final payment rate. And this is just a little bit different than how it was handled under the 2014 Farm Bill. So you'll see this note on this slide about an important change, but just note that that's not a change from 2019 or 2020 or 2021. It's actually a change from how the program functioned under the 2014 Farm Bill. Another change, again, which was a change from the 2014 Farm Bill, is that ARC payment rates will be determined by the physical location of the land. So you may have a couple of tracts on your farm and one lies in another county. So whatever payment rate applies to that county under this program will be applied to the land that physically lies there. Previously, under the 2014 Farm Bill, we would always have used the payment rate that applied to the administrative county. Okay, so moving on from ARC County, I now want to talk about ARC Individual and how that's a little bit different. So ARC Individual is really like a whole farm revenue coverage. We're not determining separate payment rates for separate crops. We're looking at all covered commodities on the farm and determining one revenue loss, taking into account all the expected revenues for those covered commodities and all the actual revenues for those covered commodities. So revenues are weighted for all those covered crops that are planted to determine the farm's overall gain or loss. Now with ARC-IC, farms must have at least 1/100th of an acre of a covered commodity actually planted to determine the revenue gain and loss. Now there is one exception, and that is for farms that are 100% approved prevent plant for covered commodities. Brad talked about 2019 and how we had the ability to look backwards per se. And we did have some farms, particularly I think in the eastern end of the state where we had some severe flooding that were 100% approved prevent plant. And so ARC-IC was a good option for those farms for 2019. It's a little hard to know at this point or by March 15th if you're going to have that situation, and we would certainly hope you didn't. However, just realize though, if you've planted a covered commodity on your farm and you also have some prevent plant acres, those prevent plant acres will not come into play in determining the actual revenue. Another piece that is different under the ARC-IC program from ARC County is that payments are issued on 65% of the farm's base acres rather than 85%. And also, production must be reported. So you will have to certify your yields both for the current year and the previous 5 years, because FSA will use those yields to establish those benchmark revenues and the actual revenues. So ARC-IC income support is provided to producers who have an interest in any of the 22 covered commodities, regardless of whether base acres exist on the farm for that commodity. So with this program, we really are looking to what crops are actually planted out there on the farm rather than what crops specifically have base acres. Producers on an ARC-IC farm who do not share in those planted covered commodities are not eligible for ARC-IC payments. And producers who do share in the covered commodities need to be sure that they're signing that ARC-IC contract to remain eligible for potential payments. I think we talked about most of these bullets. Just again, note that production reporting is required, and the deadline for that production reporting is always July 15th of the following crop year. Now with ARC County, we talked a little bit about irrigated and non-irrigated yields and how those came into play for some counties and crops. But with ARC Individual, we are always using a blended yield. So we do not determine separate revenues for irrigated and non-irrigated yields. We also include production from all ARC-IC eligible types of the covered commodity planted. And we're also including production from acres that might be hayed and grazed of covered commodities. So it's not just those acres that were planted with an intention of harvesting for grain. So ARC-IC payments are going to actually trigger when the current year revenue from all the planted covered commodities on an ARC-IC farm falls below the guaranteed revenue, which is again 86% of that benchmark revenue. So it's important to realize here that revenue from one farm or crop could potentially eliminate the revenue loss from another farm or crop because it is a whole farm revenue type product. Also take note of how the ARC-IC farm is defined. It includes your share of all planted covered commodities from all ARC-IC enrolled farms in the state. So you may have an interest in 10 farms in Nebraska, and maybe you enroll 2 of those farms in ARC-IC, and they might be in 2 different counties, but we will still look at all of the covered commodities planted on both of those farms and take those into account when we are determining expected revenue and actual revenue. Because of that, each producer will have a unique benchmark revenue calculated across all of those planted covered commodities. For example, a tenant might have an interest in 3 ARC-IC farms that has 3 different landowners. So the tenant's benchmark and actual revenue and resulting payment rate will take into account the interest on all 3 farms, but each landowner's is only going to take into account the interest on that specific farm they own. So a landowner's payment rate under this program could be very different from a tenant's payment rate just because of the difference in the farms they have an interest in. The next few slides provide an example of the ARC-IC program and how actual numbers populate into those formulas, and I think are a better example of understanding how multiple covered commodities can offset one another in that calculation. This slide just provides somewhat of a summary and a recap of the ARC and PLC programs, and I think there's some important points to make note of here as you make your program election decision. Brad did mention 2020. And for 2020, I have the figures here with regard to Nebraska and payments that were issued. PLC, we did have $26.3 million issued, and Arc County, $1.36 million, significantly lower than other years, but largely those PLC payments were due to the PLC payment that we had on wheat. So there's our reminders of the deadlines. And just please take note of that. We really encourage you to contact your county office now, early yet in this enrollment period, so you can get this enrollment and program election complete before you're needing to get out there and be busy in the field. And it really would assist our offices as well with handling the workload that comes with the ARC and PLC program. Please keep in mind that if you decide not to make a new program election, there's really nothing you would need to do in that regard. Your election from 2021 will simply roll forward. But you do need to ensure that you have a contract in place to enroll for 2022. So it's important to ensure that that step has been taken. With that, I'm going to turn the presentation over to Jessi Remmers.
Thanks, Cathy, and thanks, Brad, for the introduction. I'm Jessi Remmers. I'm going to talk to you a little bit about our non-insured crop disaster assistance program, and then I will touch briefly on the dairy coverage program. To get started, the non-insured crop disaster assistance program, or commonly called NAP, is an assistance program for producers of non-insurable crops to protect against financial losses that could occur due to impacts of natural disaster. So what does non-insurable mean? The federal government's risk management agency, go back a couple of slides, Cathy. The RMA determines the guidelines for crop insurance across the nation, and then local insurance agencies sell insurance policies that fit within those guidelines. If there's not a large scale production of the crop in a given area, then generally there's no commercially available crop insurance in the area for that crop. So if that is the case and you've checked with your crop insurance agent and coverage for that crop doesn't exist in your area, you should reach out to your local FSA office and talk to them about the availability of NAP coverage for that applicable crop. So on this slide, we've got covered commodities and natural disasters, and these are just some of them that Nebraska has. A lot of the specialty crops in Nebraska, such as fruits and vegetables, fall into our commercially uninsurable crops category. And then we also have crops like our forage crops, such as pasture and grass, sorghum forage, millet, oats, and peas. Some examples of natural disasters that NAP does cover are listed here on the right. And in addition to these, some that could pertain to Nebraska would include tornadoes, insect infestation, and disease. On this slide, we are going to talk about coverage levels And NAP is available at a basic coverage level similar to the catastrophic coverage level for crop insurance. Assistance is based on the amount of loss that exceeds 50% of the expected production at 55% of the average market price for that crop. We do offer buy-up coverage in addition to the CAT coverage, and buy-up coverage can be elected with an additional premium paid by the producer. Buy-up ranges from 50 to 65% of production in 5% increments at 100% of the average market price for the crop. So like I was saying, additional coverage has to be elected by the producer by the application closing date, and then the producers with that additional coverage have to pay a premium along with the service fee. As a side note for buy-up coverage, it is not available for grazed crops. Service fees and premiums. As we talked on the previous slide, we've got service fees and possibly premiums. A special note here is that if you fall into a category listed in red at the bottom of this slide, you're eligible to have the service fee waived and a 50% reduction from the premium. So you'll want to keep that in mind when you're talking with your county offices about NAP. For all coverage levels, the NAP service fee is the lesser of $325 per crop or $825 per producer per administrative county. Now that number cannot exceed $1,950 for producers with farming interests in multiple counties. If you elect buy-up coverage, your premium will be figured taking into consideration your share of the crop, the eligible acres of that crop, the approved yield per acre, the elected coverage level, the average market price, and then that 5.25% premium fee. To apply for coverage, producers must do so by the application closing deadline. So they must apply for coverage and also pay the applicable service fee. The coverage period for NAP varies depending on the crop. Some application periods for coverage for 2022 have already passed, such as alfalfa, mixed forages, and grass. But the application closing date for those for 2023 will be November. So you'll want to keep that in the back of your mind if you have those crops. Several crops do have a deadline coming up in the middle of March. So producers with those types of crops would want to keep that March 15th date on their radar and check into your local agency for your local county office for more information on NAP if you haven't done so already. Those crops for Nebraska with that March 15th deadline include millet, oats, peas, sorghum forage, hemp, and most of our fruits and vegetables. So that was a pretty brief overview of the non-insured crop disaster assistance program, but for additional information, we do encourage you to reach out to your local FSA office. The Dairy Margin Coverage Program, or commonly called DMC, is available for participating producers to cover the margin between the national price of milk and the cost of feed. DMC pays producers when the difference between the national price of milk and the average cost of feed falls below a certain level as selected by the producer. There's an annual administrative fee of $100 for the catastrophic coverage, and a premium charge increases above the baseline coverage. Producers can select CAT coverage, which is $4 per hundredweight for the covered production history of 5 million pounds or less, or they can select buy-up coverage, which is $4.50 to $9.50 per hundredweight in 50-cent increments. Producers will also select a coverage percentage anywhere from 5 to 95% in 5% increments. As I mentioned before, if you fall into any of the special classifications in red on this slide, the admin fee is waived. For 2021, our enrollment for Nebraska dairy producers was fairly high. About 90% of our dairies were enrolled. So we're hoping to have just as great of enrollment for 2022. The 2022 enrollment season ends February 18th. So keep that in mind. If you are a dairy producer and you feel DMC is a program that you might benefit from, we encourage you to reach out to your local county office.
Cathy, you are muted right now. There you go.
Okay, I apologize. So we'll move forward with talking about some of the pandemic assistance programs that FSA has had in place. A few of those have had the deadlines passed, but there are a couple that are still open for sign up. Okay, there I go. The Organic and Transitional Education and Certification Program does have an application deadline of February 4th. And this provides pandemic assistance to cover eligible certification and education expenses for producers who are certified organic or who are transitioning to organic. And this sort of builds upon the organic certification cost share program that FSA also has available, which covers 50% of certification expenses. So this program, OTECP, allows for an additional 25% of certification expenses. The application deadline for that, again, is February 4th. We also want to mention the Spot Market Hog Pandemic Program, or SMHPP. And this program was just rolled out December 15th. It has an application deadline of February 25th. And it's designed to assist specifically those hog producers who sold hogs on the spot market. So it was specifically a negotiated sale, and then they delivered hogs to the packer within 14 days. So we're looking for those situations where sales occurred from April 16, 2020 to September 1st, 2020. I would note there that contract producers are not eligible under the provisions of SMHPP. So here, we just want to be sure you have some of our contact information and some other resources to go to that are available. And I'll specifically note our number if you want to contact us at the Nebraska FSA State Office for more information. And also at the bottom of the slide, we've listed an ARC PLC public website that has a wealth of information if you're interested in diving into more detail about ARC PLC. Brad, I think that's all we had today.
Cathy and Jessi, thank you both very much for the information and the insight. I want to go back briefly to my presentation to share a couple slides here as we think about the road ahead. We have some questions waiting for us for some final discussion. Please, if you haven't asked a question yet, be sure to do so. You can enter a question in the Q&A section. And we'll be happy to try and address it here as we close down this afternoon. If I get control back where I can plug in, there we go. What I want to finish with is a brief bit of discussion about farm programs in the broader context of farm policy. And the best place to do that is to talk about government program payments in general. Nationally, government program payments reached record levels in 2020. But not because of commodity programs. We had a substantial shock to markets because of COVID, losses in early 2020, but by late 2020, markets had strongly rebounded and prices ended up relatively strong and continued into 2021. The substantial government payments instead in 2020 were primarily ad hoc payments, more than $35 billion of ad hoc payments in 2020. COVID relief, from both USDA and from the Small Business Administration, as well as some final payments under trade relief of 18 and 19, as well as some ad hoc agricultural disaster relief under WIP or ultimately WIP plus. In 2021, payments dropped substantially, but ad hoc payments still overwhelmed the traditional commodity program payments. So part of the challenge looking forward is what role do commodity program payments, what role, if any, do ad hoc payments play in the outlook? This was farm program payments, as we saw, impacted in 20 and 21. Ultimately, net farm income grew in 2021 because of rebounds in market and because of the growth of both good production and strong prices in 2021. If you dissect those two bars, there's essentially net income from the market and government payments in the green bar. In 2020, net farm income would have been down, but was buffered by strong and some sizable government payments. In 2021, net farm income was up, actually the third highest on record in nominal terms, and it was because of a rebounding market, even as government payments shrank. That was to see nationally. Here in Nebraska, net farm income actually hits what we think is a projected record for 2021, right around $8 billion. A substantial portion of that is still government payments, but compared to 2020, where net farm income generally was somewhat stagnant, but strong government payments helped. In 2021, it was a very strong market, very good production conditions, and a small but still relevant component of farm program payments. To picture that a little more carefully on farm program payments, USDA data through 2020 shows us that in Nebraska specifically, total farm program payments approached $2.5 billion in calendar year 2020. More than 2 billion of that was ad hoc assistance. That was again, the remainder of some trade assistance payments that rolled into 2020, as well as the primary components of COVID relief and some WIP or WIP plus ad hoc assistance payments as well. In 2021, farm program payments have dwindled, or expectations are that the final numbers will show that they fell dramatically to something in the neighborhood of 600 million, or excuse me, 800 million total payments in Nebraska for the calendar year 2020. Less than 600 million of ad hoc assistance as projected, currently subject to revision. Only, as Cathy noted earlier, less than 30 million of commodity program payments that were paid on the 2020 crop that paid out in 2021. So a real small component for commodity programs over the last couple of years, overwhelmed by the ad hoc programs. But as you look ahead, an important consideration when we talk about the next farm bill, higher prices lead to lower projected safety net spending, which we would attribute to strong markets and better economic conditions. That also means that there is a lower program baseline or budget baseline looking forward. A lower program baseline means that there are less budget dollars to allocate to programs for the next farm bill. Now, farm bill programs are projected going forward when we debate a new farm bill that's due in 2023. There's a budget to essentially pay for existing programs, assuming they're extended. That's how the baseline starts. That means there's a baseline budget to effectively extend current programs, but because that baseline budget looks like it will be small, there's relatively little money to spend on substantial changes to those programs. And arguably, in a political sense, relatively little money there to be stolen, quote unquote, or at least taken away for other priorities as well. Ad hoc spending has been the overwhelming part of the safety net the last couple of years, but ad hoc spending doesn't have a permanent authority, doesn't have an existing authority that counts for future budget projections. So if ad hoc spending really ramps down substantially even more here in 2022, Cathy and Jessi noted a few lingering programs and some final ad hoc assistance that may roll out here, but relatively little spending projected ahead. Then the farm income safety net will look relatively small in the next farm bill debate, other than crop insurance. And one thing to note, as market prices rise, as market prices have been stronger, that means the value being protected by crop insurance grows, which means premiums grow. And if premiums grow, then federal support for those premiums also grows. So crop insurance will suddenly be the biggest part of the safety net, at least on budget. based on current projections. And that means it might also be the biggest target for some policy discussions ahead. Of course, there are other many priorities. Food assistance is the overwhelming part of the whole farm bill in terms of budget, and it's clearly an issue and continuing to be a policy issue going forward. Conservation and climate policy may substantially affect the debate about a conservation title. In Nebraska, that's about $150 million a year. But recent legislation proposed to substantially expand conservation spending and even potentially double it relative to what's being spent in the farm bill. We don't have an expectation about that legislation moving forward, but even if it doesn't, there's certainly part of a farm bill debate focused on conservation spending. And there are many other priority issues, including the current chairman of the House Agriculture Committee and the focus on equity and socially disadvantaged farmers and ranchers. And so clearly there are many issues, many priorities ahead. It's just a reminder to sort of put this in context and note that the battle over the next farm bill is ready to begin. And that battle is in part impacted by the budget projection ahead. The baseline says the safety net is shrinking other than crop insurance. And that changes some of the decisions that producers have. I mentioned the other programs in the farm bill. Just remember that the farm portfolio of crop insurance, commodities, conservation adds up to something like 20%, a little bit over 20%. Nutrition by far is the biggest component of the farm bill and will continue to be a big component of the debate. And everything else that's still important, everything else is a really small slice of that overall budget, even as it is still really important from a policy perspective. That's the outlook ahead for the farm bill. What do producers do this year? We've talked about farm program decisions. We've talked about some opportunities or some complementary decisions that producers need to make. It's critical to make sound management decisions based on economics. You can factor in substantial farm program support, but recognize that safety net support may be more dependent upon crop insurance this year than farm programs, and certainly a declining role for any sort of ad hoc assistance. Manage that broader portfolio, recognizing that farm programs are an important component along with other management decisions as well. And the outlook ahead, prepare for challenges. It always is. And the policy outlook will be a challenge, potential changes ahead in the safety net. That'll be something that would affect the 2024 crop year and ahead. But be involved, be engaged. So let's leave it at that. Let me stop sharing here and invite Cathy and Jessi both to join on camera and address questions. And I want to ask first a couple questions back to Cathy and Jessi. Cathy, one question was about proven yields and ARC IC. And a reminder, how do farmers prove their history and prove their yields for ARC IC?
Right, those yields are essentially certified, but if you have documentation to provide, if there's a spot check and it is your yields or your documentation from your crop insurance agent, those generally are acceptable because those are also subject to spot check under RMA rules. So crop insurance yields can be used. There's a number of other things that can be used. If you are someone that maybe feeds your grain or cuts it for hay, talk to your local county office because we've got additional provisions that'll help you know how do I keep good records for those.
Okay. Jessi, there's a question on there, and I know you've already responded on chat as well, but could you clarify the rye as the topic, but how do you distinguish between when rye is a grain or rye might be a forage or rye might even be a cover crop? How do you designate what it is and whether it is covered by NAP or not?
Yes, absolutely. So NAP is driven off of the producer's acreage report. So whatever their intended use is for that crop that they're certifying on their acreage report is what NAP is going to pull through for their coverage. So if they're telling at acreage reporting time, they're telling the county office that they're going to plant this rye and they're going to take it for grain, and then they come in and buy their NAP and for grain, then they will have coverage on that crop. Now, if they say they're going to plant it as, or they certify it as grain, but then they take it as something else, that's a little bit different, and they need to be in communication with their local office if they're going to change that intended use.
Mhm. Okay, important considerations. The question about ad hoc and what does it stand for? And good question. Ad hoc, meaning specifically non-authorized, or at least not authorized in the traditional Farm Bill authorization. So ad hoc is essentially emergency or additional spending. The trade relief was ad hoc assistance, sort of directly implemented by USDA with existing authority. The COVID relief was ad hoc assistance legislated by Congress and implemented by USDA and other agencies. The WIP and WIP Plus programs were legislatively authorized, but again, outside of a traditional Farm Bill sense. So they are ad hoc or emergency spending. The important thing is they're one-time programs or one-time assistance. They are not a part of a legislated program with a life like the Farm Bill. So there are some disaster programs that are legislated as part of the Farm Bill and have permanent authority. The livestock forage program, the livestock indemnity program, the ELAP program, emergency, this is a quiz, emergency livestock assistance for livestock, honeybees, and farm raised fish, if I remember right, something like that. And TAP, the tree assistance program. There are 4 programs that are fundamentally permanently authorized, but WIP and WIP Plus are not permanently authorized. They were ad hoc assistance measures. Ad hoc only means they're not permanently authorized, or they're not formally authorized with a life. Therefore, they're one time and they don't create future obligations, which means there's not a future budget for them. I actually received a question via email, and I can't tell for sure whether it was someone participating or whether it was sort of serendipity that arrived at the same time. But there was a question about whether it would be beneficial to enroll in ARC-IC for 2022, given that ARC and PLC seem to be so far out of the money. So 2 considerations to start. Remembering, as Cathy, as you described, ARC-IC is this farm level protection across all commodities on that farm, program commodities on that farm. Yes, ARC at the county level is far out of the money. It would take a substantial revenue loss to trigger ARC relative to current expectations. That is current prices and benchmark yields. It would take the same percentage loss to trigger ARC-IC from whatever your current benchmark yields are and current price expectations. The probability that a farm triggers in that substantial loss is greater than the probability that a county triggers that same percentage loss. So yes, there would be a higher probability that ARC-IC pays relative to ARC County. However, it does require losses across the farm as opposed to a given crop. And whatever farm numbers you enroll in ARC-IC all count together. So it sort of bundles risk, not just across commodities, but also across farm numbers. So you want to think carefully about which farm numbers or which farms may or may not be most at risk. The question specifically sort of asks dry land. And if you are a dryland farm under drought considerations or drought concerns, then maybe ARC-IC has a stronger likelihood and a stronger role in participation. But recognize that it does take the same level of loss. It's just that it may be a higher probability that it actually triggers. And then it also pays on a smaller percentage of acres. So don't forget all the caveats. Cathy, that's my economic interpretation. Is there any sort of programmatic insight you could offer there?
I don't know that there is. I think you framed it up really well. the price mechanism as far as what is our benchmark price when we look at Arc County versus Arc IC, we're essentially using the same thing. So it really comes down more so to yields. And what would your historical yield be on your farm versus what you feel could possibly be yield for 2022? Boy, that's hard to know. I mean, that's always a question we'd like to have answered. And so it's really just, I think, looking at your individual farms. And if you feel there's conditions that could maybe benefit from having that individual farm protection, then Arc IC might be a good decision.
You bet. And you could go back to that table, as I noted, that had projections for 2022 and the required loss that it would take to trigger something. It's a substantial loss. It's such that at the county level, that degree of a yield loss is very uncommon, short of a major disaster such as drought. Even a widespread storm rarely drags the county that far. So it's few and far between that would trigger that big a loss. The individual level definitely faces that level of yield risk more than the county level does. Okay. Noting the time, we have met our 1 o'clock hour and passed here just a little bit. I think we have the questions answered that we see to date. So let me officially thank Cathy and Jessi both for your time this afternoon. A great help to explain the details and the rather large portfolio of programs that FSA continues to roll out. It's not just commodity programs. It's not just ARC and PLC. It's quite a big portfolio, and there's always information there to be gained. So thank you, Cathy. Thank you, Jessi.
Thank you.
We greatly appreciate it. And thank you to everyone else that's joined. We thank you for joining us today. Remember, this webinar recording will be posted at cap.unl.edu. You can find the presentations there as well if you're interested in the slides specifically. So you'll be able to find that soon at cap.unl.edu. You can also go to that website, find information about our other upcoming webinars. Next Thursday, we will have our regular CAP webinar again, when Curtis Mencken from the Center for Farm Financial Management at the University of Minnesota joins us to discuss Ag Plan, which is a free tool they have developed that farms and ranches can use to help write business plans for their operations. So please look ahead to join us next week for that one. Go online to cap.unl.edu to register if you're interested and find more information about our upcoming schedule. You see other programs coming up here on the agenda. We look forward to having your participation here in the coming weeks. Finally, as you leave today, don't forget that there will be an opportunity to take a brief 3-question survey that helps give feedback on this webinar and some information on our upcoming sessions your inside as well. So please click on that link that's available in the chat box. Click on that link as you get ready to leave. We'd be eager to have your participation in the survey and your information to help us with our planning. Thanks again for joining us this afternoon. Thank you again to Nebraska Farm Service Agency office for the assistance and the continued collaboration. And good afternoon to everybody.